Big news for the house hacking community. 5% down conventional mortgages on up to 4-unit properties. This is big, guys, so I wanted to make this video as quickly as I possibly can. This news just released a couple days ago, and most importantly, I want to give a video on how to capitalize on this, what it means to you if you've been struggling to find 2, 3, 4-unit property in your market. Maybe your market's a high cost of living market. There isn't much inventory out there. FHA wasn't giving you the ability to buy what you were looking to buy, or you're looking for your next deal and you're into the house hacking game. I want to tell you how this new change affects you, and it really is for the good. So I'm going to go into detail on each of the things. Just understand too, this is very new. And we're still going to probably be learning a little bit more about the really nuts and bolts of it as time continues. But ultimately, I'm a big fan of house hacking. It's how I got started in real estate investing. I've helped tons of other people do this using the 203K loan and FHA loans. Now having the conventional loan in our back pocket is another way. It's another angle. And it's really going to change the game. So I'm really excited to bring this to you and really tell you again from the buyer's side, from someone that is going to be owning this property at the end of the day. What is it like? What is it going to change for you as the buyer, right? Lenders are talking about this, what it changes for them, maybe real estate agents. What does it change for you and how are you going to benefit from it? So as these new changes come out, I will be posting more content on this and telling you how to utilize this, strategies on how to take advantage of this. So go ahead and hit subscribe and like this video, share it with other people. And as these new updates come in, I'm going to tell you exactly how to capitalize on this. So what I did is I put together a quick and dirty outline, just so I make sure that I hit as much as I possibly can on this. So we're going to go over and bring it up. So again, this is the biggest news for house hackers probably in the last couple of years. Up until this point, FHA has only been the only low down payment option for buying multifamily properties. Okay, so all of these changes don't go into effect immediately. They go into effect November 18th, 2023, right? I'm making this video right now. It's Saturday, October 7th. So it's about a month away, give or take, but you could still start getting into this now. That's why if you've been struggling, like it's time to take advantage of this when there's the lowest competition. A lot of people are going to be hearing about this over time, but for the people that are in the know, you're going to be able to take advantage of this immediately. Okay. So again, as I said in the beginning of the video, you can now buy up to a 4-unit property for the low 5% down payment. Okay. Previously, FHA only had the low down payment option of 3.5%. I'm going to tell you why the 3.5% and the 5% actually don't make much of a difference on paper. So it's essentially almost the same thing, but really the conventional mortgages have a lot more flexibility, and that's what we're going to get into. Previously, just so you know, previously it was 15% down if you wanted to buy a duplex with a conventional loan and you were going to live in the property, right? Which is crazy, right? 25% down for a triplex and quadplex. That's why, I always talk about the 203K way strategy. My strategy, if you're looking to buy a house and you're looking to buy, a multifamily property, you always were going to use a 203K loan. Obviously, we'll talk about renovation in a little bit and what changes, because there's a lot of great updates for that as well. But really, it was like, okay, well, if you're going for multifamily, you had to go for FHA. There was no 25% down, and here in New York is like, it's like $150,000, right? $200,000. Obviously, a lot of us don't have that sitting in our back pocket. So again, this was only previously reserved for FHA. But what does it mean for you? And this is what I want to dive into. If you have questions about this stuff as I go through it, leave a comment below, ask the question. If I can answer it, I happily will. And also, if you're watching this, you're a lender and you're learning this information, remember, I'm not a lender. I'm not a real estate agent. I'm just a person that reaped all the benefits of house hacking, reaped the benefits of these FHA loans, renovation loans, and I help people capitalize on this using these loans in the best way possible, the way I did. So the idea is, I'm not an expert in the lending space. I don't do lending. If you're a lender and you know some of these answers of some of these things we're about to talk about, go ahead and let me know in the comments as well. It really helps me out. So, and it helps out the community, most importantly. So what does it mean for you? So number one, first and most important, I'm going to take a sip of water for this because this is probably the biggest one. The death of the self-sufficiency test. Okay? FHA a couple years ago instituted a new rule requiring the total rents of the other units in the property to total 75% more of your total mortgage payment. Okay. Now, I have my beliefs on this, but ultimately what this was doing was this was locking a lot of people out of deals for triplexes and quadplexes. Okay, this self-sufficiency rule is basically when you're looking for move-in ready houses, very hard to find with the price environment, and now with interest rates being where they're at, it was very, very hard to see properties that pass this rule. Okay. A lot of deals were dying because of this. Now, this rule was not always around. I think it came in probably around 2020 or something like that. Again, if you're a lender and I'm wrong, please let me know in the comments. But I think it was around then. But ultimately, especially with the higher interest rates, this has been killing a lot of deals. A lot of people reach out to me saying that they can't beat self-sufficiency and everything like that. It's another topic for another day, but that's one of the benefits of the renovation loans. And we'll get into the renovation portion of conventional because conventional also has renovation loans called the home style loan, which is just like the 203K that allows you to wrap renovation into the cost. So you could buy fixer or uppers and usually get it for a lower amount of money and pass that self-sufficiency test. However, if you're looking for move-in ready house hacks or something like that, this was a killer. So conventional doesn't have self-sufficiency tests, okay? They're just looking at your qualifications if you can qualify with DTI. They don't have that hard set 75% number, okay? So again, this is a really, really big one if you've been looking and you've been getting blocked out. Now, here's the thing. I still believe the self-sufficiency test is a good test. However, it should just be a test and it really shouldn't block you from doing the transaction. If you're at 76% or 78%, you are living and dying by this appraiser. That if that appraiser just gave you an extra $100 or $200 on their estimate on what the rents would be in the other units, you would have passed. But in this case, you're not going to have that problem anymore. Okay. But the point is, guys, is like, if you are house hacking, you want to make sure that the rest of the property covers your expenses. I understand if you're renting and like, you just want to own your own property. But like having 3 other sets of tenants and not making any money off of this property, it's a headache. The whole point of house hacking, what I did was I did it to increase my cash flow. I did it to increase my equity when I renovated it. Okay. Because the idea of this is when you house hack, you want to get started into real estate investing long term. So you want to be able to get this first property to help you save, help you acquire more capital to go buy more deals. So self-sufficiency test isn't necessarily a bad thing. However, it was breaking a lot of deals. So it's a great news, again, if you are looking for something and you were just on the cusp and you won't have that problem anymore. Okay. The next very important thing here is less guidelines and requirements just in general on conventional loans. Okay. FHA guidelines, FHA became like a really bad word in the last couple of years, right? If you were in the game, I'm sure you've heard real estate agents or lenders or whoever tell you, oh, we don't want to deal with FHA. People were honestly discriminating against FHA loans, which I think is complete BS. I honestly think it should be regulated a little more because I could honestly tell you all the houses I flipped, most of the buyers were FHA buyers. And I had buyers also that were willing to put 40% down that couldn't get approved for the loan. So the idea that, FHA is for some way, shape, or form a worse loan isn't really the thing. But the next couple things I'm going to tell you are reasons why sellers were steering away from FHA, which are understandable. However, the conventional mortgage gets around those things. Again, this is why it's another win for you. So FHA guidelines have some annoying condition requirements. So if you're not doing a renovation loan on the property, right, you were just buying it traditional FHA, really nitpicky stuff on the inspection can stop the deal from going through. Okay. There's a long list of this stuff, but little things like chipped paint, broken gutters, improperly shutting doors or windows. These are little nitpicky things. And honestly, sure, they should be right, but they shouldn't be stopping you from buying your house, right? These are things that could be fixed by a handyman. They could be fixed relatively easy. The problem is FHA won't let that go through unless the seller either fixes it or gives some sort of concession, okay? Again, in this crazy market we were just having in the last couple of years, no seller was going to want to do that. They were getting 10, 15 offers on their property. You aren't going to have those things, those little nitpicky things slowing you down from closing anymore, okay? So another big win is just that the conventional has a better name. It's people don't, sellers aren't going to be as scared of it. FHA, again, just that word itself was like scaring a lot of sellers. Again, albeit good or, right or wrong, that's what was happening. So you're not going to see that as much anymore. That's, again, why watching this video and putting into action what I'm telling you here on November 18th, do it now before it starts getting word out there that this is another low down payment option. All right. Third is mortgage insurance, another big win. Okay. So one of the things, FHA has is obviously it has mortgage insurance. If you don't know what mortgage insurance is basically what FHA tax on, or any low down payment loans. But FHA, we'll use FHA as an example. FHA is a low down payment mortgage. Okay, so in an effort to get more banks to endorse these mortgages, right? Because FHA doesn't actually give the mortgage; they give the guidelines for the banks to give the mortgage. Okay. So what's the incentive for banks to give the mortgage? Well, they know that it's government backed. What happens is they're offering these very low down payment, very low, very forgiving debt to income ratio, very low credit score. They're basically giving subprime borrowers the ability to buy a house on a 30-year mortgage. So in order to give banks a little more comfort, they have this thing called mortgage insurance. What mortgage insurance is everybody that uses an FHA loan pays an extra percentage of their total loan amount every month on their mortgage payment, which is called mortgage insurance. And it's a couple extra $100 usually. It's 0.55% of your loan amount that gets tacked on each year. And it's usually, again, equates to a couple $100. But what that does is all that money goes into an insurance fund. So when any FHA loans default or anything like that, those banks get recouped and it washes itself out. I don't know the specifics, but again, it's an insurance policy. And if you are part of the low down payment club, you become part of this. So anyway, I don't want to go too much on the weeds in it, but I want you to understand that with conventional, the mortgage insurance is going to be less for most people. Okay. I will say FHA is a little better across the board spanning. But what it does for conventional is it'll reward you if you do have a decent credit score. If you do have good financials, good debt to income ratios, stuff like that, you're going to have lower and lower mortgage insurance. Okay. Another thing is that the FHA requires an upfront mortgage insurance premium of 1.5%. So remember what I was saying before about why the 3.5% and the 5% is really about the same thing. Conventional mortgages don't have that 1.5% upfront. In most cases, from what I understand. Again, lenders, keep me sane. So the idea here though is that money is going to come out no matter what. It is wrappable into the loan, so you could you could theoretically say it's not coming out of pocket, but between closing costs and everything else, you can understand that that's probably where it would be anyway. Okay, so you're probably around 5% regardless. So again, 3.5% versus 5%, it's all really a wash at the end of the day. Okay, so conventional doesn't have that 1.5% up front. And then conventional mortgages insurances adjust based on your credit profile. We all covered that. All in all, it's a win. Okay, it's a win. You're going to see lower mortgage insurance. It's going to be less money out of your pocket at the end of the day. That's all that matters. And also one very important thing, and this is big for people that are looking to do the renovation side of things, and they know they're going to create equity. This is how I coach people on the 203K side. Is I want you to create enough equity so that you can immediately refinance and get out of the mortgage insurance. With conventional now, listen to this, with conventional now, these loans allow you to take the mortgage insurance off without having to refinance. The mortgage insurance will automatically come off if you get a new appraisal and you get that 20% equity on the property. That is huge. That saves you a lot of money if you don't have to refinance. Now, with rates being where they're at, they might come down. We might be refining anyway, and hopefully you get some equity boost. And again, this is why I push the renovation side of things and building value into your property, because you want to refi, get rid of that mortgage insurance as quickly as possible, get money back in your pocket. Okay. The next one, okay, we're moving on to the next one, is one of the number one question I get about 203K loans is how many times can you do it? Right? Everyone wants to know, house hacking, how many times can we do this low down payment mortgage? Because people want to do, like, I'm going to buy a quadplex, then I'm going to move out of that and buy another quadplex, and I'm going to move out of that and buy another quadplex, and I'm going to move into the new quadplex every time. And, a couple of years, I'm going to have 15 units. Yes, in theory, okay? The FHA loan really doesn't truly allow that to happen. It does. They have the 4-3-2-1 method, which is very tricky. You have to really stay within the guidelines. I really don't know many people or any people really that have done it effectively. And it's because of FHA's requirements on your exit property. So if you live in a single family home and you want to go buy a quadplex, they don't like to see that happen. They also have a lot of regulation on what the property you're leaving. If you're going to continue to hold that and rent that out, you have to have a certain amount of equity in the property. You need to have an active rental agreement in place. You need to have you need to show bank account statements from that, showing that it's active. It becomes very difficult. Okay. With conventional, you have the ability, you don't have those guidelines, right? The rules, I don't know 100% yet. This is stuff that's still being hashed out on how it'll affect multifamily. But FHA has these departure house guidelines that stop people from doing do a house hack, move on, do a house hack, move on. Also, FHA loans, you're only allowed to have one at any given time under your name. In this case, unless you're going a far distance, okay? Conventional, you can have multiple under your name. There is a limit. I think it's 10 or something, but you see where I'm going with this. You can do that strategy a lot easier. Huge, 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 huge. All right. I want to get into probably one of the coolest things on this is the renovation aspect of it. Okay. So the renovation aspect of this is also available. Okay. So the 203K loan is the FHA loan, but it allows you to wrap renovation cost into the loan and not pay out of pocket to fix up a property. So what I did was I was able to buy a fixer-upper duplex property. It was a complete mess, complete gut job. Bought it for only 3.5% down, which was $9,500, and didn't have to pay out of pocket for the $80,000 renovation. I built it into the mortgage. So my property all in for my purchase, to purchase the property plus get the renovation was $350,000. When I was done, it was worth $480,000. So I was able to refinance, get a home equity line of credit, and pull that money out to start my real estate investing career. I was also house hacking too. So I killed two birds with one stone. Great news, the conventional loans also have this product. It's called the Fannie Mae Homestyle Loan. I am in the process of starting a renovation on my house. In this room I'm standing in right now, I keep saying it, I did not pick the wood paneling. That wasn't my style pick. We haven't renovated the house yet. We moved in. We've been going through the drawing process. Anyway, but I am doing a home style right now. You could now do this home style loan with up to 4 unit properties, still only with 5% down out of pocket, and not need to come out of pocket for renovating. So this is another great win because the home style loan is just a little easier than the 203K in terms of how the flexibilities on what you can do, what needs to be repaired, the scopes of work, everything like that. Okay. One key point I want to mention here is that the 203K still shines because you can get a higher loan to value. I don't know the specifics on the home style loan to values yet. However, on the 203K allows you to go above and beyond what your property would be worth after you renovated it. That is wild, okay? I don't condone that. I don't think it's great to over leverage yourself into your house, but if it's something where you're going to live there for the next 20 years of your life and you want to make it the best possible house for you and your family, FHA gives you that ability to go a little above because they know it's your home that you're going to be living in, and over time it'll probably even itself out. So for whatever reason, if you are one of those people and you are in that bracket, you will be able to get higher loans and more money from the FHA 203K. But again, if you go through all this process, in my opinion, you want to create equity, not lose it. So that's a key point there. The other thing is that Homestyle doesn't require a HUD consultant or 203K consultants. Here's my feeling on this. If you have a good 203K consultant, they are worth every penny and they're worth your time and they help you considerably. Okay. If you have a bad 203K consultant, it could create a ton of issues and you're better off not having one than having one at all. Okay. So that's where I lay with this. A lot of banks still require some type of 203K type consultant, someone that's usually a 203K consultant to come on your job, on your home style, on your renovation. They help you build your scope of work. They do your inspections, everything like that. A lot of banks still require that. However, it is not mandatory. We'll see how this plays out. We'll see what happens. Again, I am a firm believer that if you have a good 203K consultant, they can help you build an accurate scope of work, help you building the scope and help you with the process. They're basically like a referee. They're not helping you project manage by any means, but they will help you kind of like, get clarity on what work needs to be done and stuff like that. Okay. So again, this could be good or bad. We're going to see how this plays out. Here's a couple things we're still waiting to understand on this loan. And I'm going to add another one here because, I think I have all that, and then, cosigning. So we're going to get to that. So still waiting to understand a couple things with this. There's still some lack of clarity on how they're going to forecast the future rental income of the other units. So remember, one of the benefits of buying multifamily with FHA was that you're allowed to forecast the future rental income, the 75% of the future rental income that you would be getting from the other units. Or if there's an existing renter in there, you'd be forecasting the rents of whatever their lease is into your debt to income. So it allows you ultimately to get approved for a higher mortgage. This gives a lot of people a lot of buying power, especially if you're kind of lower on the income bracket. This is a way that you can afford to get into things that you wouldn't have been able to on your own. Okay. That's exactly how I was able to afford more. I wasn't able to afford the renovation, but once I forecasted that future rental income of that other unit, when I bought my duplex, that pushed me over to the limit just to be able to finance the renovation as well. Okay. We still have to see how that plays out. Loan level price adjustment. That's basically how your rate adjusts based on the loan amount, based on where you're at. There's a lot of flux with that. One thing about FHA is FHA is very good across the board. That's what they were good at, is kind of having a level playing field. These conventional mortgages, they have a lot more flex depending on your credit score, depending on your area, depending on your loan amounts, depending on your debt to income ratio. There's a lot more up and down. So it does reward people with better credit worthiness, better credit profiles, everything like that. And it might not be good for you if you don't have a higher credit score, if you have a tough debt to income ratio. That's when maybe you'd be dropped back into the FHA bucket. Guys, the big thing I do want to put forward is that FHA is not necessarily going to die. Okay. It's still going to have its uses for sure. I joked about it. Like, am I going to have to get rid of the 203K way in my name? I mean, listen, at the end of the day, like, these do have, they're all going to help each other, and it's good to have options, right? Competition is good. It gives us the ability to know we can get the best bang for our buck as home buyers. So that's the win here. But a good loan officer is going to tell you that, okay? If you need loan officers that are experienced with this, I'll have a link below for my Facebook group. Join the Facebook group. There's a lot of loan officers in there that know this stuff backwards and forwards and are licensed all across the US, so they can help you with this. But again, a good loan officer is going to help you put you in the best product for you, but it's good to have options. Last but not least, the cosigning. So with multifamily properties on FHA, your cosigner had to live in the property with you. Essentially, if they were on the loan, they had to occupy the property with you. If they're not, then they didn't. Unless it was a single family. Single family, it didn't matter. They didn't have to live in the property if they were a cosigner. I am still unclear on that. Again, if you're a lender, you know the answer to this, let me know in the comments. But from the research I've done, I haven't really been able to figure it out yet. But if you buy, say you are buying a quadplex and, you know, maybe you just got out of school, and, you know, you have the savings, but maybe you don't really have the income, and you have a parent or, you know, a relative that's willing to co-sign for you on the loan, to get you that approval, and you want to buy a quadplex, triplex, or duplex, we have to see if with conventional they'll allow that. So we'll see what happens there. But ultimately, self-sufficiency guidelines, the game changer. I mean, that's going to be a big one and help a lot of people. That is probably the one that I would get told the most was holding people back. The condition guidelines will be more lax and deals fall through. And less deals will fall through from this. This is another big one. Renovations will be more flexible. This is where I specialize in. So again, subscribe to this channel, like this, share this. I will be putting more content on how to utilize this. I am literally doing the conventional home style on my house right now. So I am here to help you out if you have any interest in that. And then again, just last but not least, like FHA has become a taboo word in the industry. Your offers will now look better. Okay. That's why, again, if you're watching this, put this into action. The way you offer, get out there. Start doing the work now with your lender to get you set up to take advantage of this. Come November 18th, you can start offering now on all these properties. Maybe in the past that you went in with FHA and they didn't take it. Now you can go back. Maybe there was one that you didn't hit the self-sufficiency test and it's still on the market because there's still low competition right now. You know, this is the time to strike when the iron's hot. This is why it's good to be on the cutting edge of this new stuff. If you're a house hacker, you're looking to get into this game, this is a game changer for you. If you have questions about this, I will be doing more live trainings, Q&As, and everything in my Facebook group. The Facebook group is linked down below in the description. Again, if you need lenders, that's our talking hole. This is where we all can help each other out. It's a great community of people over the years, all house hackers, people that are renovating their houses. Again, this is the exact path I took to get myself into the real estate investing game. I turned very low down payment into hundreds of thousands of dollars in equity and over $2 million in real estate in a very short amount of time using these strategies. So this is why I'm so passionate about this, because I saw what it did for me and I want it to help you. This is another great thing to add into your tool belt. Man, if I had this earlier, I definitely would have taken advantage. So hope you got a benefit out of this. Again, share this. Please subscribe to my channel if you think that you are going to be doing this. There's a lot more content coming my way. And again, comment any questions you have or any things that you want to see going forward. We'll see you on the next one. Peace.